Marcus Aurelius was the most powerful man in the world. He controlled vast wealth, commanded armies, and made decisions that affected millions. Yet when he sat down to write his personal journal, what we now call meditations, he didn't write about conquering territories or accumulating riches. He wrote about controlling his reactions, accepting uncertainty, and focusing only on what he could control. 2,000 years later, billionaire investors like Ray Dalio openly credit Stoic philosophy for their success in navigating market chaos. What did the ancient Stoics understand about risk that modern investors are desperately trying to relearn? Welcome back to the channel. Today, we're diving deep into something most investors get completely wrong: risk. Not just financial risk, but how we think about uncertainty, volatility, and loss in a way that the ancient Stoics mastered, and that could transform your entire investment approach. This isn't about specific stock picks or market timing. This is about rewiring how you think about money, loss, and decision-making under uncertainty. By the end of this video, you'll understand why the Stoic approach to risk might be the most valuable investment philosophy you've never heard of. Let's get into it. Before we talk about investing, we need to understand what Stoicism actually is, because it's not what most people think. Stoicism was founded in ancient Athens around 300 BC by a merchant named Zeno. After losing everything in a shipwreck, he turned to philosophy and developed a practical system for living well despite life's unpredictability. The core Stoic insight is deceptively simple: we don't control outcomes. We only control our judgments, decisions, and responses. The Stoics divided everything into two categories. Things within our control, our thoughts, judgments, intentions, and actions. Things outside our control, other people's actions, market movements, economic conditions, outcomes. This sounds obvious, but think about how most investors behave. They obsess over things they can't control: what the Fed will do next, whether a recession is coming, what stock prices will do tomorrow. They experience massive emotional swings based on news they have zero control over. The Stoics would say this is fundamentally irrational. Not just unprofitable, irrational. The three core Stoic disciplines are: 1. The discipline of perception. How we see and interpret events. Marcus Aurelius wrote, "Choose not to be harmed, and you won't feel harmed. Don't feel harmed, and you haven't been." 2. The discipline of action. Taking appropriate action based on our values, regardless of outcomes. Acting according to reason and virtue, not fear or greed. 3. The discipline of will. Accepting what happens with equanimity. This doesn't mean passivity, it means distinguishing between what we can change and what we must accept. Now, why does ancient philosophy matter for your portfolio? Because investing is fundamentally an exercise in dealing with uncertainty. The market doesn't care about your plans, your retirement timeline, or how much you need that 10% return. Traditional finance tries to quantify risk with standard deviations, sharp ratios, and value at risk models. These tools have their place, but they miss something crucial: the biggest investment risks aren't mathematical, they're psychological. The real risks are: panic selling at the bottom because you can't handle volatility. Chasing returns at the peak because everyone else is getting rich. Making emotional decisions based on financial news designed to trigger emotional decisions. Failing to act on your long-term plan because short-term noise overwhelms you. This is where Stoicism becomes incredibly powerful. The Stoics developed sophisticated mental models for handling exactly these situations: uncertainty, loss, fear, and maintaining rationality when everyone around you is losing their minds. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That's pure Stoicism, maintaining your judgment independent of the crowd's emotional state. The Stoic view of wealth. Let's address something important. Did the Stoics think wealth was bad? No. This is a common misconception. Seneca, one of the greatest Stoic philosophers, was one of the wealthiest men in Rome. Marcus Aurelius was literally the Roman emperor. Stoics didn't reject wealth, they had a sophisticated view of what wealth means and how to relate to it. The Stoics called things like money, health, and reputation preferred indifference. They're preferable to have, but they're not essential to the good life. More importantly, they're outside your complete control. Seneca wrote, "It is not the man who has too little, but the man who craves more, that is poor." The Stoic approach to wealth has three components. 1. Wealth is a tool, not a goal. Money should serve your values and enable virtue, it's not an end in itself. The question isn't how can I get rich, but what kind of life do I want to live, and how does money help me live it? 2. Practice poverty to appreciate abundance. The Stoics regularly practiced voluntary discomfort, eating simple meals, sleeping on hard beds, imagining losing everything. This wasn't masochism, it was inoculation against fortune's reversals. Seneca would set aside several days each month to eat the cheapest food and live simply, saying, "Set aside a certain number of days, during which you shall be content with the scantiest and cheapest fare, that it may be a test of endurance and not a mere hobby." 3. Prepare for loss. The Stoic practice of premeditatio malorum, premeditation of adversity, involves visualizing potential losses before they happen. This isn't pessimism, it's preparation. It strips future losses of their power to devastate you. Marcus Aurelius wrote, "External things are not the problem. It's your assessment of them, which you can erase right now." This is radically different from how most investors think about wealth. Most people have their entire identity and happiness tied to their net worth. The Stoics would say this makes you a slave to fortune, you've given your peace of mind away to things you don't control. The Stoic calculus of risk. Now we get to the heart of the matter, how do Stoics think about taking risks? Here's what most people get wrong, they think Stoicism means avoiding risk, playing it safe, being passive. That's completely backwards. The Stoics were some of the most accomplished people in history, emperors, senators, military commanders, successful merchants. These weren't people avoiding risk. They were people who understood how to take calculated risks rationally. Let's break down the Stoic risk framework. Step 1. Clarify what you can control. Before taking any risk, you must distinguish. What aspects of this decision are within my control? Your research, position sizing, entry criteria, risk management. What aspects are outside my control? Market direction, news events, what other investors do. This immediately focuses your energy on the only things that matter, your preparation and your decisions. Step 2. Apply the dichotomy of control to outcomes. Epictetus taught, make the best use of what is in your power, and take the rest as it happens. In investment terms, you control whether you do thorough research, you don't control whether the company succeeds. You control your position size, you don't control whether the market crashes tomorrow. You control your exit strategy, you don't control whether you exit at the optimal price. The Stoic investor focuses effort exclusively on the controllable factors and accepts the uncontrollable factors with equanimity. Step 3. Evaluate risks through the lens of virtue. The Stoics believed in 4 cardinal virtues: wisdom, justice, courage, and moderation. Every risk should be evaluated against these. Wisdom. Is this decision based on careful thinking and genuine understanding, or am I following the crowd? Justice. Does this investment align with my values? Am I contributing to something I believe in? Courage. Am I taking this risk from a position of rational confidence, or avoiding it from irrational fear? Moderation. Am I risking an appropriate amount relative to my circumstances, or am I being greedy or reckless? Step 4. Practice negative visualization. Before taking any risk, the Stoic deliberately visualizes it going wrong. Not to avoid the risk, but to ensure you can survive the worst case. Reduce the emotional impact if it happens. Identify hidden risks you haven't considered. Confirm you're truly comfortable with the risk. The Stoic position on loss. Let's talk about something every investor faces: losses. The average investor has a completely dysfunctional relationship with losses. They're attached to unrealized gains as if they're already real. They hold losing positions forever because selling makes the loss real. They check their portfolio obsessively, experiencing emotional turbulence with every 1% move. The Stoics had a radically different view. Loss is inevitable and natural. Seneca wrote, "We suffer more in imagination than in reality." Most investment anxiety comes from imagining losses, not experiencing them. The Stoic accepts that. Markets go down as well as up. Some investments will fail no matter how good your analysis. Volatility is the price of admission for long-term returns. Unrealized gains don't belong to you yet. The practice of amor fati. Perhaps the most powerful Stoic concept is amor fati, love of fate. Not just accepting what happens, but embracing it. Nietzsche, influenced heavily by Stoicism, wrote, "My formula for greatness in a human being is amor fati, that one wants nothing to be different, not forward, not backward, not in all eternity." Applied to investing, every drawdown, every failed investment, every missed opportunity, these aren't obstacles to your success. They are your success story. They're the price of participating in markets that, over time, create wealth. The investor who loses 20% in a correction and learns to stay calm has gained something more valuable than the 20% they lost. They've gained psychological resilience that will serve them for decades. Case study, the Stoic investor in 2008. Let's make this concrete. Imagine two investors facing the 2008 financial crisis. Investor A, the reactive investor. Portfolio down 40% by March 2009. Checks portfolio multiple times daily, experiences intense anxiety. Convinced the system is collapsing, this time is different. Sells everything at the bottom to preserve what's left. Sits in cash for years, missing the entire recovery. Still bitter about 2008 losses 15 years later. Investor B, the Stoic investor. Let's walk through how a Stoic framework would handle this. October 2008, markets in freefall. Application of dichotomy of control. I cannot control whether Lehman Brothers failed or whether the market continues to fall. These are outside my control, so I won't waste energy worrying about them. I can control my actions. I can review my portfolio rationally. I can check whether I'm overleveraged. I can ensure I won't need this money in the near term. Negative visualization. I visualized this possibility before. I knew markets could fall 50%. I sized my positions to survive this. I have emergency cash reserves. I'm prepared. Action from virtue. Wisdom. History shows that panics create opportunities. Prices don't reflect fundamental values right now. Courage. Everyone is fearful. This is exactly when Buffett says to be greedy. Moderation. I won't bet everything on a recovery, but I won't abandon my long-term plan either. March 2009, portfolio down 40%. Reframing the loss. This loss is only real if I sell. The companies I own are still producing value. Market prices are votes in the short term, weighing machines in the long term. Today's vote doesn't matter. What have I learned? I was overweighted in financials. I didn't fully understand my exposure. This is valuable knowledge. Amor fati. This crisis is my opportunity. I'm buying quality companies at prices I'll never see again. This is exactly why I keep cash reserves and contribute monthly regardless of market conditions. 2010 to 2015, the recovery. The Stoic investor not only recovered but significantly outperformed by maintaining positions through the bottom, adding to positions in 2009 when prices were depressed, learning portfolio lessons that prevented future mistakes, developing psychological resilience for future drawdowns. Most importantly, they didn't suffer. The reactive investor experienced years of anxiety and regret. The Stoic investor experienced the same. 2010 to 2015, the recovery. The Stoic investor not only recovered but significantly outperformed by maintaining positions through the bottom, adding to positions in 2009 when prices were depressed, learning portfolio lessons that prevented future mistakes, developing psychological resilience for future drawdowns. Most importantly, they didn't suffer. The reactive investor experienced years of anxiety and regret. The Stoic investor experienced the same events but maintained equanimity throughout. This is the power of the Stoic approach. It's not just about returns, though the returns are better. It's about living well while investing, not in spite of it. Your Stoic IPS should include 1. Your investment purpose. Why are you investing? What's the money for? When will you need it? This creates the context for all decisions. I am investing to fund retirement in 25 years. I do not need this money before then. Short-term volatility is irrelevant to my goals. 2. Your risk capacity and risk tolerance. Not just your theoretical risk tolerance, but an honest assessment. What drawdown could you experience without panic selling? Based on historical data, I should expect to see 30 to 50% drawdowns in an equity-heavy portfolio. I have prepared for this through negative visualization and accept this as the cost of long-term returns. 3. Your asset allocation. Determined rationally, not emotionally. Based on your timeline, goals, and genuine risk tolerance. I will maintain 70% stocks, 25% bonds, 5% cash. I will rebalance when any category exceeds its target by 10%. 4. Your decision rules. Specific rules for when you'll buy, sell, or rebalance. These prevent emotional decision-making. I will not sell holdings due to market volatility. I will only sell when A. The investment thesis has fundamentally changed, B. I've found a significantly better opportunity, or C. Rebalancing requires it. 5. Your loss scenarios. Here's where premeditatio malorum comes in. Explicitly visualize and write down. If my portfolio falls 30%, I will remind myself that I expected this possibility. I will review each position to ensure the fundamentals remain intact. I will not sell solely due to price declines. I will consider adding to positions if I have additional capital. If my portfolio falls 50%, I will remember that Japan fell 80% and took decades to recover, yet I'm not 100% in Japanese stocks. I will remember that the US market has always recovered. I will consider this an opportunity to buy quality assets at depression prices. The power of writing this down when you're calm cannot be overstated. Your future panicked self can read your past rational self's instructions. Strategy 2. Stoic position sizing. Position sizing is where most investors destroy themselves. They concentrate too much in winners that reverse, or they size positions too large and can't psychologically handle the volatility. The Stoic approach to position sizing has 3 principles. Principle 1. Size positions to maintain equanimity. Seneca wrote, "Wealth is the slave of a wise man, the master of a fool." Your position sizes should allow you to sleep well. If a position is large enough that daily movements affect your mood, your decision-making, or your peace of mind, it's too large. A practical rule: no single position should be large enough that its complete loss would force a major life change. For most people, this means individual positions of 5 to 10% maximum. Principle 2. Risk parity from a Stoic lens. Traditional risk parity focuses on volatility. Stoic risk parity focuses on psychological impact. Ask yourself, if this position went to 0 tomorrow, how would I feel? If the answer is devastated, position too large. If the answer is disappointed but fine, position appropriately sized. If the answer is barely noticeable, position possibly too small for meaningful impact. Principle 3. Reserve cash for opportunities. The Stoics emphasized being prepared for fortune's reversals. In investing, this means maintaining dry powder. Many investors are 100% invested all the time, because they can't stand missing out on gains. This violates Stoic principles. It assumes you control market timing, you don't. It prevents you from acting when others panic. It leaves you psychologically unprepared for drawdowns. A Stoic investor maintains 5 to 15% cash reserves specifically for adding to positions during market dislocations, maintaining psychological comfort during volatility, having options when opportunities appear. Strategy 3, Stoic routine and market detachment. The Stoics lived by routines and rituals. Marcus Aurelius started each day with meditation. Seneca practiced daily self-examination. These routines created psychological stability. The Stoic investor needs similar routines to maintain rational distance from market chaos. The morning routine. Many investors start their day checking their portfolio or reading market news. This is like starting your day by checking what everyone on social media thinks of you. It makes their opinions control your mood. Instead, the Stoic investor might review their investment thesis and long-term goals first. Practice negative visualization. The market could fall 10% today, and I will be fine. Read something educational rather than reactive market commentary. Only then check prices, with explicit mental framing that today's prices don't matter. The checking routine. How often should you check your portfolio? The Stoic answer, as infrequently as your strategy requires. If you're a long-term buy and hold investor, checking daily serves no purpose except emotional volatility. Weekly or monthly is sufficient. Each time you check, frame it, I am gathering information, not seeking validation. If prices are down, that's neutral or positive, I can buy more. If prices are up, that's neutral, I expected long-term appreciation. The evening reflection. Seneca wrote, the spirit ought to be brought up for examination daily. End each day or week with self-examination. Did I make any investment decisions today? Were they based on reason or emotion? Did I react emotionally to market movements? What triggered that reaction? Am I following my investment policy statement? What did I learn? This reflection creates a feedback loop of continuous improvement, separate from whether your portfolio went up or down. Strategy 4, Stoic rebalancing. Rebalancing is philosophically Stoic. It requires you to act contrary to emotional impulses. When you rebalance, you sell what's done well, feels bad, you might miss more gains. Buy what's done poorly, feels bad, you're buying losers. This is exactly the kind of action Stoics excelled at, doing what reason demands even when emotions resist. The checking routine. How often should you check your portfolio? The Stoic answer, as infrequently as your strategy requires. If you're a long-term buy and hold investor, checking daily serves no purpose except emotional volatility. Weekly or monthly is sufficient. Each time you check, frame it, I am gathering information, not seeking validation. If prices are down, that's neutral or positive, I can buy more. If prices are up, that's neutral, I expected long-term appreciation. The evening reflection. Seneca wrote, the spirit ought to be brought up for examination daily. End each day or week with self-examination. Did I make any investment decisions today? Were they based on reason or emotion? Did I react emotionally to market movements? What triggered that reaction? Am I following my investment policy statement? What did I learn? This reflection creates a feedback loop of continuous improvement, separate from whether your portfolio went up or down. Strategy 4, Stoic rebalancing. Rebalancing is philosophically Stoic. It requires you to act contrary to emotional impulses. When you rebalance, you sell what's done well, feels bad, you might miss more gains. Buy what's done poorly, feels bad, you're buying losers. This is exactly the kind of action Stoics excelled at, doing what reason demands even when emotions resist. The Stoic rebalancing framework. 1. Set automatic rules. Don't decide each time whether to rebalance. Decide in advance, I rebalance when any asset class exceeds its target by 10%, or every 12 months, whichever comes first. This removes emotion from the decision. 2. Reframe rebalancing emotionally. Selling winners, I'm taking profits from what's expensive and moving it to what's cheap. This is disciplined trading. Buying losers, I'm buying at a discount what I already believed was worth owning at higher prices. This is rational. 3. Use contributions for psychological ease. Instead of selling winners to buy losers, use new contributions to bring underweight assets back to target. This achieves rebalancing without triggering the loss aversion of selling. 4. Extreme rebalancing during crisis. The true Stoic rebalancing opportunity comes during market panics. When your equity allocation has fallen from 70% to 50% because stocks crashed, the rational action is to sell bonds and buy stocks. This is extremely difficult emotionally, you're buying something that's falling, but it's a pure application of buying low and selling high. The Stoic investor prepared for this scenario through negative visualization and documented decision rules. When it happens, they act according to plan, not emotion. The view from above. One of the most powerful Stoic meditation techniques is called the view from above, imagining yourself from a cosmic perspective, seeing how small your concerns are in the vastness of space and time. Marcus Aurelius wrote, "All things fade into the storied past, and in a little while are shrouded in oblivion." Applied to investing, this is transformative. When your portfolio drops 15% and you're feeling anxious, practice the view from above. Zoom out from today to this week, does today's price really matter? Zoom out from this week to this year, will you remember this week in December? Zoom out from this year to your investing lifetime, will a single bad year destroy a 30-year plan? Zoom out from your lifetime to human history, investing is a first-world problem in the vast sweep of human experience. This isn't minimizing your concerns. It's correctly calibrating them. A 15% drawdown feels catastrophic in the moment but is utterly ordinary across investing history. The view from above reminds you, this is normal. This is temporary. This doesn't matter nearly as much as it feels like it matters right now. Stoic wealth management, enough. One of the most important Stoic questions for investors, when is enough, enough? Modern investing culture promotes endless accumulation. You're supposed to want more forever. But the Stoics would say this makes you a slave, you'll never be satisfied, never at peace. Seneca wrote, "It is not the man who has too little, but the man who craves more, that is poor." The Stoic concept of enough. At some point, additional wealth doesn't meaningfully improve your life. This point is different for everyone, but pretending it doesn't exist is irrational. Questions to clarify your enough. What do I actually need to live the life I want? At what net worth would my fundamental life concerns be resolved? What am I actually pursuing, more security, more freedom, more status, or just more? Once you've defined enough, your relationship with investing changes. Before enough, investing is about building security and options. Risk is necessary. Volatility is acceptable because you need growth. After enough, you're playing a different game. You're defending what you have rather than reaching for more. Taking unnecessary risks becomes irrational, you're risking something meaningful for something marginal. Many investors destroy themselves by continuing to play the aggressive growth game after they've already won. They have enough, but they risk it trying to get more, and they lose. The Stoic investor recognizes when the game has changed. The Stoic investor in bull markets, 63:30-68:00. We've talked a lot about bear markets and adversity, but what about bull markets? Bull markets might be harder for the Stoic investor than bear markets. Here's why. In bear markets, Stoic virtues align with good investing: courage to hold, discipline to buy, equanimity about losses. In bull markets, Stoic virtues require you to act contrary to what everyone around you is doing. The challenge of FOMO. When everyone around you is getting rich from cryptocurrency, meme stocks, or whatever the mania of the day is, the Stoic investor must maintain discipline. This requires 1. Clarity about your investment thesis. I invest in businesses with durable competitive advantages and reasonable valuations. That strategy works over decades. What others are doing is irrelevant to my plan. 2. Acceptance of opportunity cost. I will miss some gains. This is certain. Someone will always be getting richer faster than me. I accept this as the price of rationality. 3. Humility about knowledge. Maybe cryptocurrency will make people millionaires. I don't understand it well enough to risk meaningful capital on it. Staying within my circle of competence is more important than chasing every opportunity. The challenge of overconfidence. Bull markets make everyone feel like geniuses. Your portfolio is up 50%. You're reading about investing. You feel like you've figured it out. The Stoic investor practices self-awareness. Am I making money because I'm skilled, or because everything is going up? Have I truly been tested, or have I just been lucky? Marcus Aurelius, everything we hear is an opinion, not a fact. Everything we see is a perspective, not the truth. Your bull market gains might be skill, or they might be luck. The Stoic maintains uncertainty about which is which. The practice of voluntary restraint. Perhaps the most difficult Stoic practice in a bull market, deliberately not maximizing gains. The Stoic investor might keep rebalancing into bonds even though stocks are soaring. Maintain cash reserves even though being fully invested would generate higher returns. Stick to quality companies even though speculative plays are doubling monthly. This feels like leaving money on the table. It is leaving money on the table. But the Stoic investor asks, what am I optimizing for? Maximum returns, or maintaining the psychological and financial stability to stay invested for decades? Seneca, if a person doesn't know to which port they sail, no wind is favorable. The person chasing maximum returns in a bull market often destroys themselves in the subsequent bust. The Stoic investor accepts lower returns in exchange for sustainability. Let's bring this all together. The Stoic approach to risk and investing isn't primarily about making more money, though it probably will make you more money. It's about maintaining your humanity, your rationality, and your peace of mind while participating in markets that are designed to trigger your worst impulses. The core Stoic insights for investors. Focus exclusively on what you control, your research, your decisions, your behavior. Release attachment to outcomes. Prepare for adversity before it arrives. Negative visualization and written plans ensure your future self has guidance from your rational self. Treat losses as information, not identity. Every loss teaches. Extract the lesson, discard the emotion. Size positions to maintain equanimity. Wealth should serve your peace of mind, not destroy it. Define and respect. Enough. The game changes when you've won. Recognize that transition. Practice restraint in manias. The ability to not participate in irrational exuberance is a superpower. Marcus Aurelius wrote, "You have power over your mind, not outside events." Realize this, and you will find strength. Let's bring this all together. The Stoic approach to risk and investing isn't primarily about making more money, though it probably will make you more money. It's about maintaining your humanity, your rationality, and your peace of mind while participating in markets that are designed to trigger your worst impulses. The core Stoic insights for investors. Focus exclusively on what you control, your research, your decisions, your behavior. Release attachment to outcomes. Prepare for adversity before it arrives. Negative visualization and written plans ensure your future self has guidance from your rational self. Treat losses as information, not identity. Every loss teaches. Extract the lesson, discard the emotion. Size positions to maintain equanimity. wealth should serve your peace of mind, not destroy it. Define and respect enough. The game changes when you've won. Recognize that transition. Practice restraint and manias. The ability to not participate in irrational exuberance is a superpower. Marcus Aurelius wrote, "You have power over your mind, not outside events." Realize this, and you will find strength. This is the essence of Stoic investing. Markets will do what they do. Companies will succeed or fail. Prices will rise and fall. These are outside your control. What you control is your preparation, your discipline, your emotional responses, and your decisions. Focus your energy there, and you become nearly invincible as an investor, not because you're immune to losses, but because losses no longer have power over you. The paradox is this: by caring less about whether you make money, you'll probably make more money. By focusing less on outcomes and more on process, your outcomes improve. By preparing for loss, you position yourself to profit from others' panic. This is what the Stoics understood 2,000 years ago and what modern investors are desperately trying to relearn. Success comes not from controlling outcomes, but from controlling yourself. If this video changed how you think about investing, hit that like button and subscribe. We're exploring the intersection of philosophy and practical finance every week. And remember, the obstacle is the way. The next market crash isn't something to fear, it's your opportunity to test whether you've truly internalized these principles. Until next time, stay rational, stay disciplined, and stay stoic.